Thanks, Lakshmi. Hello, everybody. Trust you all are having a great time being part of Finacle Conclave, and welcome to this session on corporate cash management for the evolving normal. I'm Rahul Wadhavkar, head of Finacle's commercial banking product management team in North America, and I have the privilege of moderating this discussion today. As the impact of pandemic continues to disrupt our businesses globally, the need for corporates to closely monitor and manage their liquidity and working capital positions almost on a real-time basis has never been more pronounced. Is the role of financial institutions changing in this environment? How have banks been leveraging digital tools to mature their cash management services and keep pace with evolving expectations? What have some of the leading banks done to help their clients respond better and revive faster? These are some of the themes we are going to be discussing today. And in many ways, after the experience of last 10 months, these really are some of the contemporary issues dominating the world of cash management globally today. And to talk about all of this, it is my pleasure to introduce to you our panelists for today. Venkat ES, Managing Director, Head of APAC Treasury Product Management, Bank of America. Brent Stevens, Head of Liquidity Solutions, Westpac Institutional Bank, and Balaji Natarajan, Head of Payments and Cash Management, Asia at ANZ Bank. Gentlemen, thank you so much for making the time to be on our panel discussion today. So, Venkat, let me start with you. We have been in this pandemic situation for last 8 to 10 months now. Many of us are moving to an adapt or a reinvent phase from the initial shock phase that we were in, say, February of previous year. If you were to reflect back on your business strategies, how has Bank of America been able to help your clients better navigate their treasury or cash management challenges in this period?
Hey, thanks, Rahul. First of all, Happy New Year to all of you. And it's a privilege to be part of this panel along with Balaji and Brent, good old friends. And really thank Infosys for arranging this conclave and being part of this conclave is a really a great pleasure. It's a great question, Rahul. If you look at the world, especially the financial services industry, banking in particular, catering to corporates and institutional clients on the cash management, it is clearly a demarcation, a world before COVID and after COVID. As we get into 2021, hopefully the world would be a better place. One thing what we have seen through the last year is the pandemic has forced a number of trend-setting changes across industries, particularly in how the banks are able to deliver their services to the clients. When it comes to challenges faced by the clients during the COVID, what we have seen, what we experienced is predominantly on four distinct areas, if I may. One is the client-centric approach and the client connectivity. How banks are able to kind of connect with the clients, most of them working remotely, and then most of them not having access to their regular office apparatus. So one thing what we did in Bank of America is to make sure that is our primary objective, how to get the client connectivity better, right? In terms of managing their issues, staying close to them, engaging with them as close as we can, and then making sure that how they can navigate those unprecedented times, the lockdowns, the work from homes, the remote working, lack of access to systems and whatnot. Mm-hmm. In all this, when it comes to cash management, the primary concern for most of the clients is on managing their liquidity. The onset of pandemic, we saw there is a lot of scrambling for liquidity. Most of the clients trying to get as much liquidity in store. As things got a little bit more clearer, clients got relaxed a little bit and then try to kind of let go of some of that liquidity. But throughout the 2020, throughout the pandemic, and even today, the liquidity and staying in cash is their primary objective, and that's where we come into play in terms of how we could help them, making them effective use of their funds, especially in a low interest rate environment and trying to get cash out of the trapped countries, especially in an Asia perspective.
Mm-hmm.
The third aspect is in terms of how do we accelerate the whole digitalization process for our clients. Paper to electronic has always been the case, has always been the focus, not only for us, I guess for most of the global banks, but more so the pandemic actually forced everyone to accelerate that pace as to how to convert the digitalization. One of the things that we did in our bank is basically acceptance of digital signatures, launching virtual corporate credit cards, trying to use our online banking platform, which is called CashPro, enhancing the service levels through that, make them as a self-servicing tools, and then help the clients in the process so that they get access to the banking services and needs 24/7, uninterrupted. And last but not the least is helping them with their workflow. Quite a few clients have not thought through some of the ramifications of this pandemic, so to say, in terms of how to deal with a business contingency plan. While they have, but it was never utilized. So that's where we came into play and then try to kind of help them how to construct and design and then follow a business contingency planning process. More so, when you increase the pace of digitalization, you also get into other areas of risk, especially on the cyber security, frauds, and whatnot. And that's where our expertise and experience came to play to help them navigate that and to help them overcome that. And then in the process, the business remains as usual to the extent that is possible and feasible. Liquidity is available all the times for them, and then they're able to conduct their business and operations seamlessly.
Absolutely. I think definitely that was the theme that we did hear from a lot of our customers as well, making sure the liquidity was that view banks are able to provide them to the clients. And then, of course, the digitization aspect, Venkat, that you hit upon. But sticking with COVID, Brent, I was recently watching a cricket game in Australia on television, of course, and I was absolutely surprised initially at spectators. They were not sort of socially distanced. There weren't as many masks as what we are used to seeing here in the in North America, and obviously it was the signs were life was limping back to normal, and that was something that was very, very heartening for us to see. So Brent, tell me, is this because of the toughest lockdowns that Australia imposed initially that's helping it cope with the second wave of COVID better? And my question to you, really, from a cash management perspective, is: do you see a sense of normality returning in your clients' businesses, and what strategies have worked for Westpac to help your clients come out of this difficult phase?
Sure. So I echo Venkat's comments. Thank you, Finacle team. Thank you, Rahul. Very happy to be here and presenting with these colleagues. So I think the answer to the question, Rahul, is yes, there is some form of normalcy coming in, and what you see on television in terms of the cricket matches, it just goes to show that the way that Australia deals with things is very harshly and very intentionally, so that life can get back to where it is. And we've had some quite serious lockdowns, and it goes to show why there may be some normalcy is because the first lockdowns, just like across the world, were countrywide in nature, and now what you're seeing is localized lockdowns. Mm-hmm. And from a client's perspective, a corporate client's perspective, you're saying, well, how do we deal with this, and how are we helping them? And digitization, but specifically within their receivable stream. That's one way. Visualization, as Venkat was getting to, the importance of liquidity management, and then the third is process, as Venkat talked to as well. So when we think about the digitalization of those revenue streams and getting away from paper or cash type of instruments and getting away from brick and mortar, it's all about avoiding the disruption. And in the first lockdown, it was about avoiding countrywide disruption. Mm-hmm. And we had a few clients that I'll speak to later on specific digitalization strategies that had none. intentionally, shockingly, and now do. And when you come to that, it starts to be say, how do we get back to normalization? It's about diversion. So if you think about businesses that still rely on brick and mortar, even if the payments are merchant or electronic in nature, but people with people, and that facilitating the interaction of payment, being able to have these localized lockdowns, diverting payments to digital streams or online type of payments, and continuing your working capital receivables flow to have minimal disruption on your liquidity is what's really key there. And that's where we're seeing this time around, we're not seeing the same reaction, the same, not that word, but panic, but just we need to do something immediately right now to change. We're seeing clients be able to execute on what they implemented at the beginning of 2020 with us, and be more nimble with the diversion of that income to minimize that cash flow disruption. The other side is obviously the visualization and trying to go as long and as hard as we can into any form of treasury dashboard, any form of cash flow visualizations. Many clients at the regional or global level have treasury management systems that help them with this. Some of those clients have gone even deeper with those TMS capabilities. Some clients have onboarded to dashboarding capabilities that we have, but just ultimately, do I have visibility of it? Do I have control of it? Where do I get to the point where I need to access that additional credit facility as I do? And how can I collect and centralize cash, especially whether it's across countries, cross currencies, or just across accounts, like Venkat had pointed to. And the final one is really process. In the first outbreak, it was to the point where we were still shockingly dependent on paper and signed documents. Signatures were making their way through. And this doesn't go just for cash management. This goes for credit documents and things like that. And the organizational adaptation on both the side of the bank and the side of the client to be able to accept digital signatures broadly across a larger range of documents, because that just keeps the friction out of the easy things within business. And within COVID, you have your serious working capital disruptions, and then you have your pain points. And that the pain points of the remote working from home that was talked about before, and just having the right internet connection, having the right speed, all those little things. It's the digitization of the processes, the workflow that helps. So each one of those, as we've seen these localized outbreaks in Brisbane being the latest, in Sydney, in Victoria, the second time around, we've actually seen it significantly less disruption from our clients as compared to March, April, May last year. So I do think there's a normalization. I think if anything, this industry learns very, very quickly. It reprioritizes very, very quickly. And I think that overall, clients are stronger today than they were 12 months ago.
Absolutely. They were, and we do have a question later that I want to ask maybe you or Venkat in terms of some of the countries that didn't have this signature digitization regulations in place. How are they coping with it? But sticking with the theme of cash flow and liquidity management, Balaji, I want to quickly jump over to you. Given that cash flows and business outlook is sector or sort of industry segment specific, and each one of them have had their own impacts from a pandemic perspective. What our viewers would love to hear is how has ANZ helped their clients around managing the liquidity and managing the cash position, especially during the last 8 or 10 months?
Sure. First of all, thanks, Rahul, and thanks, fellow panelists. I think it's a beautiful question flowing from what Venkat and Brent had put the context on how the banks in general have acted. From our lens, the way we are looked at is that the banks exist to serve the community. There is a purpose, right? And these are critical times when the banks have to step up to the plate. So the first thing, obviously, is that you listen to customers, you understand your customer needs. And specifically when such a pandemic creates a distortion in the whole ecosystem, in terms of certain industries being able to adapt better, they have a better liquidity position, whereas the others have seen demands completely go out. So we had to therefore understand, work more closely with each customer in terms of who has a more liquidity preference, especially those who don't see their receivables coming in early. We had to ensure that they get the right support, and our own views about which industries are going to come through fast in terms of recovery, which are going to take a much longer term. So the key is that the banks had to adapt and be more agile in terms of how we are reacting to the customer, also being mindful of our own operations being implicated with the same pandemic, how quickly we are back on stream so that we can support the customers. So the two priorities is that one, listening close to the customer and the specific industries, what they exactly want at that time. Like Venkat mentioned, the liquidity, and same what Brent had mentioned. So the looking back the last 1 year or so, we can clearly see certain patterns that at the initial stage, everybody wanted to have a liquidity preference to meet their obligations. Then for some who had a visibility on their cash flows coming in, they could go to the market, get alternate funding, depending upon their horizon, which means the banks had to step up in terms of how we are able to support their operations on an ongoing basis when many of them, or rather almost everybody started working from home, right? You don't have access to the same kind of office environment. So self-serve was something what we enabled quite promptly, which allowed customers to have a control over their accounts. And the some of the things which are more fundamental, which you talked earlier, is also that uh, typically there is a cash in the ecosystem, right? I mean, you are at a branch offices or satellite places, but this lockdown, there's no cash, right? How do you therefore handle even some of those trivial needs which are taken for granted, right? So you have to put together a quicker solution where digital modes of payments, be it partnering for commercial cards or even store value cards in certain cases, because they had also had to support their employees. So a number of initiatives had to be adopted to each of the industries to align. But fundamentally, it taught us that we have to be a shock absorber, right? You have to absorb other shock, but you also have to be operational, right? So those are the primary parts. And fundamentally, it started that we have to start thinking ahead of some of the risks, which we have not factored in. Nobody ever envisaged the pandemic or a BCP plan that would last this long, right? You had contingencies which are defined for a certain measured period, right? Nobody thought, and now we are seeing second waves, right? Those second wave, the reactions have been far better. We could anticipate that if there's a lockdown now, how can you operate? I mean, so I think there are a number of areas, and primarily staying close to those customers, taking a view on how long that particular industry can come through is something what's becoming visible now. So I would basically say understanding the customer, being agile, and being able to absorb the shock and support them as they change their operating models is really been the key to us.
Very, very true. I mentioned earlier, many banks are moving from a shock to adapt or a reinvent phase. And we do hear from banks and analysts that the pandemic, in no uncertain terms, has really accelerated the digitization programs across industries, segments, and enterprises. So, Venkat, a twofold question to you. From a lessons learned perspective, what should banks do to reimagine their treasury services technology proposition for corporates? As in, what is the new normal? And second part of the same question is, if you were to find a silver lining in the whole story, based on your experience, are we better prepared to handle something of this scale in the future?
Absolutely, Rahul. See, the core tenets of any cash management or a transaction banking service is based on global consistency, transparency, and providing the holistic delivery of solutions. Typically, banks would always be focused on digitization, which is basically converting paper to electronic. And now, with the pandemic, I have seen banks focusing a step more from digitization to digitalization. What I mean by that is bringing in an enhanced value proposition, not just automating the solutions, but bringing in the complete holistic automated solutions to meet to the customer's needs. Balaji spoke about how you need to kind of focus on what the client needs are. Brent spoke about how, especially in a pandemic situation, one needs to be focused on not only on the liquidity but also on the work processes. When it comes to the technology or the kind of tools that are available to the banks right now and also to the corporates is only got a lot more pronounced. Exciting developments in the form of APIs, real-time solutions with predictive capability, 24/7 payments and FX capabilities, real-time liquidity management, and some of the concept that Brent and Balaji alluded to in terms of intelligent receivables reconciliation. With all these, like now you have artificial intelligence, you have machine learning solutions, which has enormous potential to fundamentally change the traditional banking paradigms if leveraged appropriately. So that's where I think banks need to reimagine how best this is the time for us to kind of embrace all these technologies to a great advantage and then enable highly customized solutions through automated solution delivery to each client's specific needs and objectives, making funds, data, and insights. Ultimately, cash management is all about funds, data, and insights so that they can get all these three delivered seamlessly and in an uninterrupted way across different time zones, different currency and clearing systems, different geographies, and then typical limitations which would have experienced otherwise, right? So the must-haves for any bank is to focus on platform-based approach with flexibility to integrate almost in a plug-and-play manner with partners like yours and other credible fintechs out there in the ecosystem, and making the most effective use of the API technology, which was unimaginable a couple of years earlier. The pandemic has only made all these things to be rethinking and reimagining, not only for the banks, but also for the corporates. Second, in terms of willingness to collaborate with the right partners, with the right tech capabilities. It's always the dilemma for global banks is between buy or build. I think that is almost settled. It's better to collaborate and then kind of partner with rather than buy or build kind of this one, so that one can really optimize on the ecosystem. The third must-have is in terms of vision and goal that needs to be a little bit more strategic, given the learnings that the pandemic has given and how markets, industries, client segments have faced these challenges and how banks have responded to overcome those challenges. The vision and goal has to be transformational, but the execution has to be incremental now so that the value proposition in terms of what I spoke about earlier, digitalization, can be really made available to the clients. That's how I think both the treasury transformation on the corporate side and the banks to cater to that requirements would come into play to make this a better place for everybody to kind of capitalize on.
Right. And Venkat, to that point, a real quick follow-up on that. This process that you mentioned of digitization and acceleration towards digitization, do you see that trend focused on large global banks or in the region, or even mid-sized regional banks are also embarking on the same theme?
Again, Rahul, it's I think it is almost an imperative, irrespective of the size of the bank and irrespective of the nature of the bank, depending upon what client segments they cater to. Some of these, say, local banks, or which has only one country presence, their client base is predominantly on the retail and also on the SME segment. So to that extent, they also have to go through the same process. There is no escape than to digitalize their solutions so that the clients are getting the value that they expect from the banks. And same goes with the regional banks, same goes with the global banks as well. Only thing what I've seen is the variance is only in the degree and the scale of such digitalization. When it comes to global banks operating in multiple geography, multiple regulatory regimes, multiple client segments, the scale and scope of the digitalization gets expanded, and then that's where the challenge and the opportunity lies for the global banks.
Very true. Very true. Brent, I want to quickly jump on to the other favorite industry topic when we really compare consumer banking technology with commercial banking technology. What's been your experience in this? I mean, has everything in the last 10 months highlighted the gulf between the two lines of businesses and the technology maturity, or the other way around it? I mean, has digital engagements and digital experiences come in more prominent focus within corporate banking world because of what we have gone through in the last 10 months?
Yeah, absolutely. So we think of it as a lot of these industry trends or these technology trends start in the consumer or the retail side of things. You can solve for a pretty easy proposition, provide a pretty unique experience, and then the corporate world takes that on. And in this case, what we've really had to do to adapt here is think about those very, very heavy C2B clients within our space. So being predominantly a domestic retail bank, a lot of our institutional clients would choose a bank like us as a partner because they have a significant consumer base and they need to be able to access that consumer base at many points. So the type of commercial bank to commercial client to consumer experience that we've been really heavily working on, I alluded it to before, but it has to do a lot with those sales that still require a touch point. And I can try to go through it quickly, but just to give the mindset of what's been so important to us in helping our clients through these times is we had a brick and mortar business that is entirely, their sales process was entirely brick and mortar. And we had approached them in the past about a digitalization of receivable strategy. And they actually said a core value proposition of our products and services is the in-store experience. And we want our customers in store. And at this point in time, they were limited to only by design, click and collect. That was the full extent of their online strategy. So you could search for items. You could say you wanted to pick it up, but the payment and the service was there. Clearly, that is something that just cannot survive in the future world. And in the nimbleness of the switching and that localized shutdown that I talked about is an imperative. And the avoiding disruption to the cash flow in this cash crunch crisis is an imperative. And it's ultimately made them, I think, a stronger company going forward. But what we had to do as a business is be able to say, okay, those products that are heavily consumer centric, so like a merchant product, for example, merchant acquiring and terminals, how do we get that and the experience that we have there online as quickly as possible? So can we set up a completely online receivable strategy within a matter of a few days? And that's what we were challenged to do with this client when they picked up the phone and said, hey, I want to progress with those ideas that you talked to me about a few months back. And really having the pressure to be able to do that. In the other way, it's about really rethinking the client's business process. And this is when it kind of moves from Treasury and Treasury centralization based objectives and efficiency that Venkat was talking about before, which I think is paramount, into the client experience. And that's where a large drive-through client that we look at, where the vast majority of their sales are all drive-through, was saying we have 3 different points that we have to take one order from. Why do we do that? Why have we designed it that way? Why have we even built our buildings in that way? When really, how do you get me to one? I need you to design a process to where I can have one touch point, one human interaction, because that's better for society. And it's actually improves efficiency to me in terms of having more sales. So what Venkat and Balaji were talking about before is this has actually been something that, while disruptive and while painful, has actually given a more robust experience going forward for those clients. So we've really focused on that kind of consumer to business and how quickly and how nimbly we can set that up for our clients, so they in turn can be a lot more nimble from a cash management and liquidity perspective.
Absolutely, absolutely. And since we are talking about cash flows, Balaji, one of the common things that we did hear from banks and even some of the corporates that we talk to, it's the forecasting models around cash flows themselves. Some of them are no longer valid, and some of the corporates are having a sort of a rethink about that in terms of what should the new models look like. What is the new expectation around this in the industry?
Sure. I think the modeling is based on history, right? Nobody ever saw a pandemic like this and the kind of stuff, right? So it not applies just only to cash flow, but for practically any kind of demand forecasting, the models had to be relooked. But going back to a little bit on the fundamentals, right? I mean, cash flows either from investment activities or from operational activities, which has traditionally been the area of uncertainty. A couple of things what I think will be increasingly factored into these models is that, concepts like value at risk, right, used for risk management on other asset prices are something which would start increasingly coming in, simply because one, the uncertainty around when you receive your receivables is one of the factors, right? But some of the behavioral shifts which are coming in, like payment methods, right? Why can't there be real-time payments accepted as the preferred mode of receiving payment or collecting payments, right? That shift to real-time payments, even on the B2B space, is one of the drivers which would reduce the uncertainty what you would see, rather than waiting for the clearinghouse, especially when you're having a liquidity kind of preference, right? So that is one of the shifts what we see. So therefore, a payment method, the risk management around variability of the cash flows would take a stronger precedence in terms of how people would want to look at cash flow forecasting, right? The second thing which would also happen is that this has really tested the movement of funds across countries, and also in terms of the timeliness of it, right? Where you need funds may not be necessarily where you have been collecting, while the forecast says that you would receive, the timing difference, the challenges. So that's the other element which should come in. And some of the things which would adequately start getting factored in a little bit more on the investment cash flows is that you had predicted reinvestment options with interest rates going a different way due to the monetary policy support which is required. That's a big shift, right? I mean, people would have forecasted that I would lock down this and use those funds at a particular time. Now we have to redeploy those funds or pull back. So that's a fundamental construct. So in effect, the scenarios what a typical cash flow forecasting models envisage has to be much more broader, has to take in the volatility of both the returns as well as the uncertainty around the actual flows itself being happening. Those are two critical elements. And thirdly, the dimension of the tenor of the cash flow forecast, what you do, is something what will be factored in together with the kind of payment methods or the collection methods which will get deployed, much like what Brent and Venkat said. The digitalization kind of exercise, which is almost a prerequisite for everybody, is something which will have a major influence of how you model your cash flows, right? Your model is no longer just going to be only physical. If it's already hybrid, it'll probably shift more towards the digital side, which means you get a better visibility, and you would also want to prefer greater certainty on the cash flows. So I think some of those things which are like, okay, it's manageable, it's kind of certain, that is completely going to change. And these would be the additional parameters, especially around variability of receipts, the tenor, visibility, and the newer digital models of receiving payments would be factors into the cash flow.
Absolutely. And that's where in Finacle, we actually see a use case around liquidity and AI coming very closely together to bring in that certainty and a high level of confidence in cash flows, Balaji, what you talked about. Venkat, you mentioned earlier about Treasury centralization. Most of the banks talk to us about centralizing their payment infrastructure, centralizing their liquidity infrastructure, and all of that. But are you seeing a change from the other side in terms of the corporate side? Is there a higher push towards treasury centralization based on what we have gone through in the last 1 year?
Certainly, Rahul. I think what the pandemic has done is every corporate treasury to rethink their approach towards centralized versus decentralized model. Individual industries and then client segments have made their own decisions earlier as to what is in their best interest. And with this pandemic, what was more important is for anybody at a headquarter, at a CFO level, at a corporate treasurer's level, she or he needs to have a better control, a consistency and visibility into their treasury operations that's happening globally, and more importantly, how best they could become more resilient to face any unforeseen and unprecedented challenge like the pandemic has confronted with. The pace at which corporate treasurers are looking at centralization has only increased as what we have experienced in the last 1 year. Every global corporate treasurer that we have looked into or spoken to, they all have expressed their keen interest and also the urgency to go centralized model for the simple reason that only for the reason that I mentioned earlier, they would like to have a better control on their cash flows, their operational models, and at the same time give the flexibility to the local units in different countries across multiple geographies to cater and to be compliant with the local tax or regulatory or the local market practices that they would need to survive and succeed in that particular market. One thing what we have been consistently advising most of our clients, and that's where what most of the global banks, not only us, have come up with instituting within the bank, within the transaction banking setup, a treasury advisory capability. And these are all corporate treasurers with considerable years of experience, having worked in large global corporate treasuries, managed those practices, and then succeeded. Those are the ones who are coming onto the banking side as part of our treasury advisory team. They look at each and every client, each and every industry, each and every market, and then advise them on a consultative basis to be a trusted advisor to help them how to go about the treasury centralization. And what it does is it gives them the global knowledge and also the practical aspects of how to cater and be compliant with the tax and regulatory aspects of as well. And I think that's been the increasing trend with most of the global banks, how to make the transaction banking offering itself to provide a holistic solution to clients across the global and local payments, receipts, reconciliation, liquidity management, and then how to leverage, like I mentioned earlier, all the digital platforms and the latest tools that is made available to them to bring about the optimal, best treasury centralized strategy and execution methodology. So, in short, Rahul, the whole idea is the importance of treasury centralization is more pronounced in the last maybe year and a half, and that's where we are seeing more and more clients adopting to centralized approach rather than a decentralized one.
Absolutely. Brent, you mentioned about API and open banking. So quick question, what's been the level of interest from your commercial client base? Are they using them? And is there a way to monetize them from a bank's perspective?
We are pushing APIs very, very hard. Balaji talked about 24/7 business and clients' expectation that everything's always on. Venkat had talked about APIs being a few years ago something that just didn't seem to be as feasible as all of a sudden they become. And we believe it is absolutely core within the proposition that we have going forward, and our clients are uptaking them. Treasury centralization takes a lot of buy-in from obviously the treasurer, from CFO, from the operations departments, but also from technology, because technology is what enables that treasury centralization, along with some of the shared experience and really good ideas that those trusted advisors provide on the consultative basis that Venkat spoke to. Being able to truly realize that, and the banks to provide that real-time always-on service, because our clients are increasingly global in nature, or clients are becoming global in nature. So their client base is going global, or their supply chain is global. So to what Balaji said before, the banks don't have the liberty of just operating around the local country's clearing cycle anymore, is we have to provide information and we have to provide services that are always on. And it's not just APIs and the real-time service that they provide and the richness of information and flexibility of information they can provide, but actually REST APIs are what we're heavily investing in. So truly standardized APIs, because that gets into some of the principles of that treasury centralization work around the standardization breeds simplification, breeds de-risking. And when you look at the most standardized types of APIs, you're starting to have not only the value proposition of real-time, always-on business information as you need it, but in the format that you need that's standardized. So that is something that we are going heavily into, have been going heavily into, and have a lot of clients investing in. Westpac's always relied a bit on the connectivity proposition in terms of our value proposition, our client base. On open banking, interestingly, in Australia, it's informational only at this point in time. It's not like the UK where you can actually initiate payments off of it. We have a lot of interest, and I think the services that Venkat talked to in terms of a transaction bank moving out of just core payables, receivables, liquidity management account services, but into more informational advisory data analytics services in the proposition of insight breeds awareness, and awareness breeds action, and action is how the client improves their businesses. We think open banking is going to be a way to further that practice even more, and empowering data analytics from not just one provider, but a multitude of providers. I personally feel when Australia does get to the point of actually having payment initiation, it will become even a larger impact on the commercial scale as well.
Thank you. Balaji, we talked about earlier about digitization, and I think Brent mentioned that one of the things that really helped their customers was the document digitization that improved the process flow. Now, not all countries in Asia have regulations around this. So do you expect more sort of action around this from regulators? Do you expect the commercial cash management, commercial banking industry to make some sort of progress in this in Asia?
Yeah, it's a good one, Rahul, simply because what we are talking about is not specific to banking or even cash management, right? I mean, most countries today, I mean, in the last 9 months or so, have initiated exercises where if there is not a digital identity or a digital documentation laws around accepting them, many of them have started creating framework, tabling into their environment to have them adopted. We therefore have seen some countries taking lead, launching national infrastructure, which could be used for establishing digital identity, providing that legal framework for accepting digital document. I'm using the word again, digital document in the sense what you relate to, with the same legal sanctity as any other physical paper, right? So there are markets which have moved ahead. Your legal terms completely allow for a non-paper digital environment. And there are countries which also have started issuing or promoting what previously was already existing as well, like India, for example. They used to have the digital signature, but now that is getting very popular simply because it is common across industries, across banks, across partners to use a government-issued certifying authority-based digital certificates. So accepting that within the banking environment is one of the things. You had Singapore also creating a digital entity, a digital identity solution, which is accessible for government services, but also opened up for banks in terms of an authentication tool. So the whole gamut of digitalization, and specifically from a documentation perspective, transcends the simple fact of validity of a physical document to a larger digital identity and the legal framework in terms of that. And clearly, this is a path with every government and every country is looking to progress, right? It's a matter of who is going to be the leader in this. And we'll probably at some stage see interoperability across. The big challenge today is that the framework which exists in one country is not exactly replicable into others. So at some point, that interoperability of the digital acceptance, both the identity as well as the legal framework, is something which is key. There are solutions which typically go into blockchain, trade platforms, and other things. But at a fundamental level, this is one of those constructs what I believe will come up sooner than later. And this has much broader ramification than simply banking or even cash management and trade.
Absolutely. I agree. Now I'm going to jump through some of the questions real fast. Venkat, virtual account management, another new thing in the industry. Everybody is very excited about this. Corporates are looking at this very, very favorably. What's your strategy and what's been your experience?
It's interesting, Rahul. I was smiling as you were asking that question. In all our conversations, or maybe Brent and Balaji would watch for that as well. In any cash management RFP that comes to any bank, one of the first things that's asked by corporates is how could they simplify their account structure, which is spread across multiple geographies and multiple currencies and whatnot. Any corporate treasury would go enormous amount of pain by having too many accounts, because one, you need to keep control on it, you need to keep complete visibility on it, you need to ensure the operational risk and the fraud, anything that creeps into those accounts are kept, and there is no idle cash left in those accounts. And then you want to make sure that the reporting for regulatory purposes or tax purposes is all taken care of. So by and large, over the years, the tendency is towards try to simplify the account structure, keep as minimal accounts as possible. And in fact, given an option, any global or a regional corporate treasurer would say, if I've been given an opportunity to hold only one account and conduct all my operations, they would take it with a lot of acceptance. And I think that's where the virtual account solution and the innovation surrounding virtual account solutions come to play. Increasingly, we are seeing that is solutions coming and evolving a lot more faster than ever before. In fact, we are one of the first banks to launch a complete holistic integrated virtual account management proposition for large multinational clients in Europe region, in EMEA, and then fast expanding into other regions across Asia Pacific as well as Latin America. We all know what virtual account solutions would give because it gives us all-round benefits both to the clients as well as to the banks. Only thing is, it comes with a lot of challenges because one, the regulatory framework needs to facilitate and enable offering the virtual account management solution. In EMEA region, it's a lot more simpler because it's one SEPA, one Eurozone, and by and large, there the acceptance and with a lot of APIs and open banking coming into play, across receivables, payments, liquidity management, and account structures can still be managed in a virtual manner. When it comes to a diverse region like Asia Pacific, it becomes a lot more complicated and complex, right? So if one were to look at offering a multi-bank, multi-currency virtual account offering on a global scale, that has still many challenges, like local regulatory, currency regulations, restrictions, interbank settlement considerations, cutoff times, etc. But this is something, a space that one needs to watch out for. Two enablers. One, of course, the technology solutions. Someone like what Infosys has been on the forefront in the EMEA region, offering virtual account solutions for quite a few banks. That's fast evolving. Second, as I mentioned before, the local regulatory regimes and the local regulatory practices need to change. But this is going to be a fundamental need for most of the corporate treasurers. But at the same time, it's going to be a transformational enabler to the next phase of efficient corporate treasury management across any large multinational company. So this is where both the treasurers as well as the banks are focused on. Only hope that the pace gathers more momentum in the days to come, hopefully in the next 1 to 2 years.
Absolutely. Thank you. Thank you so much, Venkat. Similar question on real-time payments and something like Swift GPI. Balaji, are you seeing a business case for corporates to actually move from the traditional forms of payment over to these more faster payments? Are they sensing a business need to do that?
Absolutely. I think one of the lessons, if I can use the word lesson, is really post this exercise is really the corporates wanting to have visibility, and the GPI, especially on the cross-border space, has been a phenomenal tool. Traditional banking channel, you get end-to-end visibility, the status, and that traditionally the inquiries to the banks have always been about the status of the transaction, right? Has the payments been reached? My beneficiary says he hasn't yet received. So GPI has been a fantastic tool, both for the instructing bank as well as for the instructed bank, the recipient bank, to provide that layer of an additional information flow. It could be real time, it could be even a little later kind of situation, but it's been a great thing. And we are seeing fantastic traction with not only our corporate clients, but also with our agency banking clients to have visibility on that. Now, what is also changing, we talked about it a little earlier, is on the real-time payments, right? I'm a cash flow visibility. Can I realize funds faster, right? With finality. And that's what real-time payments is coming up, not just only in the consumer to consumer or consumer to business, but also in the B2B space. And what we would probably see going forward is some interoperability or interconnection on some of the real-time payment networks in certain geographies. We already had Singapore and Thailand talk about integrating the real-time payment networks. And there are many other markets where the regulators would facilitate that kind of a boundary. So you would therefore have multiple means to not only transfer funds on a cross-border basis, but also on a real-time basis. Now, together with some of the stuff what Swift themselves are doing as an infrastructure player, we do see greater interest from corporates to get that real-time visibility about funds and also actual ability to receive the funds.
Yeah, if I may just add to what Balaji alluded to, two things about real-time payments. One, typically when we talk about real-time payments, everybody is talking about faster, swifter, making payments. But the greater importance is on the real-time payments for managing the receivables. End of the day, any B2B proposition or B2C or B2B2C proposition, funds coming into the account, and to that extent, receivables is recognized in real time, that triggers the whole lot of the actual supply chain activity. Like, for example, of the bottom end of the pyramid, dealers, distributors on which the corporates would not have the credit exposures, if they are being sold on a cash basis, the next consignment for them is dependent on how fast they are able to recognize and reconcile that the payment has come from their particular dealer for the earlier consignment. So to that extent, the sales velocity increases. To that extent, it's an automated process to account for all the sundry data that they might have, whether it is cash on a credit basis. That's number one. The importance of real-time payments in receivables is far more higher as more and more countries develop the RTP systems, and also, like Balaji said, the cross-border real-time payments, right? Like, now, if it is cross-border, it's even more better. And that's where Swift GPI comes into play. And then that's where the networks collaborating together, like between Singapore and Thailand, or I even heard Singapore and India, between two real-time payment networks coming together. That's one. And second one is real-time payments, when we talk about, has given a lot more flexibility for corporate treasuries to manage their liquidity. But when it comes to B2B, it's still evolving, right? Like now, at the odd hours, like typically we all used to work in a normal office hours. Now this is 24/7. In a 24/7 scenario, how does one come into play managing the liquidity at the middle of the night when nobody is around, right? So those liquidity management practices would have a bearing on how the real-time payments, especially on the B2B side, with large value transfers taking place without any limitations. That is a space to watch out for.
Agree. I completely agree with that, Venkat. One last question to Brent. No cash management discussion is complete without talking about fintechs and collaboration that banks have with fintechs in the innovation space. Where do you see that going, and what have you been doing on your side in this space?
So I think overall for the industry, for corporate clients and for retail clients, it's a win in terms of the collaboration with fintechs and banks. And it could be the bank buying fintechs and expanding services. It could be the banks partnering with fintechs and providing overall better services. Or it could be the bank just getting out of its comfort zone and doing something a little bit different because of the pressure from fintechs. So one example of those additional services in that latter category, Westpac has entered the banking as a service market. And that is the idea of trying to build that neobank environment within Australia. And provide it. Somebody had mentioned reliable fintechs earlier in the presentation, and it's meant to be the reliability on the bank balance sheet side, but the ability for our corporate clients and for them to be the distributor and for them to have that real relationship connection with the client, and not just that traditional brick and mortar, traditional banking advertising type of relationship. And what that does is it allows some of the larger players like banks to then delve into new technologies, new services, new things, and act like a fintech that's separately spun out from the heritage organization. So overall, the corporate clients get to go into new services that they don't ultimately offer today, and retail clients get more expanded services themselves. The flip side of that story, kind of focusing more on the traditional commercial client base and corporate client base, is truly the data vendors that are coming in and the power of data analytics. And I had said it before, that insight breeds awareness, and awareness breeds action, and action is the way that the clients make better businesses, and we help enable that. But it's not just having the data and being able to dashboard the data. It goes into that diagnostics side of data. So a client sitting here saying, tell me what you know that I don't know about my own flows, right? What can you see? Because if you can see kind of everything that's going through your processes, you can certainly tell what a very optimal strategy is. And what can you tell me is a diagnostic, with me having to tell you very little and just providing you with my business, that you can provide value to my business. So that banks thinking about data as an asset, data in the way that fintechs look at data, and those types of insights are another value to the industry itself. And no conversation is complete without saying the buy now, pay later model. And that is really helping the C2B clients have more flexibility across the spectrum of their ability to continue their cash flows, sell more product, increase revenue, et cetera, and improve the overall performance of the organization by having additional revenue streams in the buy now, pay later, where they may not be able to sell anything in just the traditional buy now model. So banks being able to partner with buy now, pay later providers to be able to help our clients cash flow and overall drive revenue and performance of their organization. So the list goes on and on, Rahul. Like you said, you can't have any of these conversations without talking about fintech. But those are some of the things that we are going a bit heavy in. That's some of the ideas that are helping hopefully foster an overall better environment for our respective market and foster better services to clients, whether they be retail clients or whether they be corporates. And I really feel that banks are at the point where the push from fintechs is a really good one, because it's ultimately making everybody better. A bit of discomfort, as we learned from COVID, actually breeds better processes and better businesses in the long term.
Absolutely, I agree. Gentlemen, that's about the time that we have for today, and I see we are receiving some questions from our audience. Let's do a real quick rapid fire on a couple of these important questions that have come about. 30 seconds to answer, whoever wants to pick it up. Fraud and cybersecurity, a lot of attacks around this during this COVID time frame. How has this played out? Can you share your views? What additional measures are banks taken to heighten this vulnerability, to address this vulnerability? Who wants to take that?
So probably I'll do that.
Yeah, sure.
Sure, no problem. See, this is going to be a measure of trust. The new measure of trust in the digital world about the bank, besides the liquidity, is about how safe and secure you are, right? So this is completely the in thing for everybody. The big operational risk and what regulators also monitor about banks is your availability of the system and the security around your services to the customer. And this goes back to the foundation of creating trust still within the banking system. What this has actually has caused is that not only the cost of vulnerability has gone up, the ease with which something could be made vulnerable has come down, meaning you can easily spoof, you can fairly send out various means of creating potential fraud. And therefore, the cost of making sure that the environment you operate is secure is something which is becoming more and more valuable and trusted. And banks being a custodian of trust, trust in a cyber world or in a digital world is again a prerogative of banks to step up. And most banks have basically done this, right? I mean, one incident, right, the entire industry comes together, we analyze, we get together and do the thing which basically lifts up the game. I'll possibly leave it to Venkat or Brent if they have additional comments to add on.
I have one more question that has come up, and I think our audience will be interested in hearing your views on this. We talked about digitization and acceleration of digitization. How's the role of relationship manager evolving? What happens to that traditional role? Brent, you want to take a stab at it?
Yeah, let me take that.
Or Venkat, yeah, whoever.
Yeah, let me take that. Let me take that. Balaji and Brent, if you're okay. Yeah, see, I go to my own experience, right? When I was a relationship manager, before a client meeting, I had to kind of struggle digging into various information sources. One, like Brent mentioned, to let the client know what they know about themselves, and also let the client know what they don't know about themselves, which banks as such as we know. And as the relationship manager, I would endeavor to kind of bring that value to them to showcase what is that they should be looking at and how that could be turned into an advantage or into a value proposition. So fast forward today, given all the tools that are available in terms of business intelligence, data analytics, advanced analytics, with all of that, it's just one, you have the source of the transaction data before going into a client meeting. Second, you can juxtapose that with the big data that is available outside of your realm, and also bring the metadata to bring in all the industry trends and other things. So when you go into a client meeting, as a relationship manager, you are armed and you are powered with enormous business intelligence, which should lead the client to think through and then make an appropriate decision for their own good, whether it is launching into a new market or going into a new proposition or raising additional liquidity or even managing the risk. Whichever way one could look at it, there are phenomenal opportunities that are made available to a relationship manager, and it's a completely a transformational one. But I would still see this is just a beginning, and with more predictive analytics and then a lot more counterintuitive intelligence that is being made possible with the machine learning capabilities, it can only get better, and RM could only feel more powerful than ever before.
Absolutely. With that, gentlemen, we have come to the end of this session. Thank you so much for a very, very stimulating discussion. A big thank you to all our viewers for spending your time with us. And of course, as we said earlier, we have a bunch of questions that have come forward. Some of those we couldn't get to today. So we will reach out to you separately and send out those responses from the panel over email. Do feel free to come back and view the recording. Look out for a follow-up email from our team with a video link, and please feel free to share the same with your colleagues. I hope you stay tuned to Finacle Conclave and enjoy the high-quality speakers and discussions lined up for you. Goodbye and stay safe.